All right, welcome back to class. I think today we'll formally begin discussion on a very important aspect of the bilateral relationship. We've previously discussed the political disputes that remain outstanding in the context of India and China, and I think given the developments of um, the last 2 decades, it does make sense to briefly also discuss their bilateral economic ties. When I say the last 2 decades, my mind goes back to the period of the 2008 financial crisis. My mind goes back to the subsequent crisis in the Eurozone, following which you also had credit defaults in the US. And overall, in the last couple of years, there's been some kind of a slowdown, whether you look at Greece or whether you look at some of the other economies. And amidst all of this, you have a scenario where, starting from the 2008 financial crisis, we've had both India as well as China being very resilient. So that would be the opening remark that I would like to draw your attention to. Um, both India and China, they have exhibited different growth rates. In the Chinese case, the development pathway was primarily focused on investment in infrastructure. The fact that in infrastructure building or investment in ports, roads, and other kinds of infrastructure allows for backward linkages, forward linkages. You build a road, it not just connects the urban center with the rural area, but it also creates demand for cement, iron and steel, bitumen, tar. It creates employment. People who get wages then go back to the market and start buying new things. So that's where the logic of backward linkages, forward linkages comes up. The Chinese model was again focused on manufacturing. So you look at the Chinese case and compare it to India, you find that we've been managing quite well in terms of our transition from being agrarian to a services driven economy. And the fact that our manufacturing is lagging is exhibited by the kind of focus that has been there in the country over the last 20 odd years in terms of suitable policies, starting with the National Manufacturing Policy, the NMP, in 2005, to the present day version that we have, the Make in India. In terms of the advantage that India has had, how it managed this transition from agriculture to services, again, the point here that is highlighted by scholars is that we managed that transition successfully given the availability of a young population, the fact that our demography has a lot of youth, the fact that India had a better proficient young demography, along with the fact that we had a solid uh, internet connection. All of this meant that basically you could have business process outsourcing being outsourced to Indian companies, wherein a lot of Western business models could then be adapted to a low cost Indian environment. So it is not an exaggeration to say, and I often use this example that whenever someone is asking for why the tube in the UK might be delayed, and if they call up the helpline and want to see why there's a delay, it might be somebody sitting in Gurgaon that is answering based on real time data, that there might be some maintenance work on the line, because of which in real time there might be a 7 or 8 minute delay. I mean, this is just an example to help you understand that there are several tasks ranging from customer service to the more obvious software programming, coding, banking services, etc., where India has been able to sort of make a mark for itself. So, with this brief introductory contrast between the two economies, I think what makes sense would be to look at how the relationship has evolved. I think in our discussion relating to the political dispute, it was evident that we fought a war with China in 1962 for a very brief month-long period, but that certainly seems to have affected the bilateral relations for the next 3 decades, the following 3 decades. So if you look at the 70s, if you look at the 80s, and roughly it was in the 90s that you had some momentum returning to the bilateral economic relationship. The fact that in the 90s you had a reciprocatory visit by China's Li Peng, a reciprocatory visit for the previous visit by then Prime Minister Rajiv Gandhi. And that was what allowed these bilateral ties to, in a way, take off or resume to some kind of normalcy. So there was this interruption, if you may, between the war and the subsequent decades, where, as you have previously heard in the lectures, where there was some kind of a low in the bilateral relationship following the 1962 war. But by the time you reach the 1990s, there is this normalcy that thankfully resumes in the bilateral relationship. 1990s were also a very interesting period for both countries. If you recollect the lectures from economic reforms, you would be able to relate the 1990s with the third wave of reforms that we discussed, which was basically China's push for maybe more economic reforms and not less, maybe faster economic reforms and not slower economic reforms. And the 1990s were also a unique point for India because that was the period that reflected our embrace of the Washington Consensus, basically the fact that India was now liberalizing. Compared to the 1980s, this was a stark contrast. India successfully managed to move away from being a mixed economy, which had a lot of welfarist conditions and which was rightfully required at that point in time. Mind you, I mean, we are looking at India, which was emasculated by the time of independence, and from that time onwards, whether it was per capita health requirements, whether it was literacy requirements, whether it was availability of schools, whether it was the reach for education, whether it was diseases, whether it was vaccination programs, the challenges were far too many post independence. So there was a certain welfarist need at that point in time, and it worked to our advantage because till 1978 we were doing much better than China on most metrics, right? So of course there would have been certain issues, and those who support markets, those who support free liberal markets, and the fact that markets are the best indicators for efficiency, they would say that, well, a mixed kind of a strategy where the state has more welfarist concerns and other kind of interventions leads to maybe below par performance. But that's a debate for which there's been no final word on, right? I mean, that's a debate that continues even to this day. How much of state intervention is good? Is state intervention good? There would be some that would suggest that markets, if they are left to themselves, might create drastically mismanaged situations, as we have seen in the East Asian financial crisis, where one after the other, starting with the collapse of the Thai baht, subsequently spreading to Indonesia and other parts of East Asia, you've had private enterprises just withdrawing funds from the economy and allowing these economies to collapse, almost creating some kind of a domino effect. Now, compared to this, I mean, of course, the debate between those who advocate for free markets and those who advocate for maybe some kind of a state or supervision or some kind of a state role, of course, that debate is not what we are trying to settle here. The point that we are trying to settle is that India did make that transition by embracing the Washington Consensus. India did make that transition by undertaking free market reforms, and the fact that with our embrace of the Washington Consensus, we were now having to sort of compete with maybe the entry of foreign players and maybe a better integration with foreign markets compared to what used to be the pre 1990s era, right? So this is the context in which we find India and China also resuming normalcy in their relations. So what I've tried to lay out is give you a context not just in the bilateral relationship, the fact that the bilateral relationship was beginning to renormalize after the 62 war. By the 1990s, they were trying to renormalize. I'm also trying to give you a historical context that it was happening in the context of India embracing the Washington Consensus and liberalization, and also China moving into the third wave of reforms. So both contexts you have to keep in mind, and it is only then you will be able to appreciate why 1990s are mentioned as some kind of a takeoff point for the bilateral relationship to really take off. Of course, trade starts out in terms of very low values and very low volumes. That's to be expected because 1990s, mid 1990s, 95, 96 is when the bilateral relationship really takes off. But then once it takes off and we move into the turn of the century, you find that the relationship really sort of accelerates. And if you look at the trends, with the turn of the century, moving into another decade, 2010 onwards, the trend again seems to be that there is this consistent increase as far as China's exports to India is concerned. And although India's exports to China might have risen, the increase seems to be very marginal. So that's the first point that one keeps in mind, that in terms of the bilateral relations, although the relations take off by the middle of the 1990s, it seems to be that it has worked to China's favor in terms of China being able to export much more to India than what it buys from India. Now, a couple of questions that come to mind in a buyer-seller relationship. It's rare that you find what is being sold and what is being bought would always be equal, therefore creating a trade balance that is equal to zero. That's not something that you normally find in any dyadic data. You look at US China, you look at India UAE, you look at China Brazil, you look at China Russia, India Russia, you'll never find a scenario where of course exports are equal to imports, and therefore the idea here is not to sort of wishfully think that somehow the numbers should be equal. That's not something that you find in international trade, because in international trade you buy wherever it's cheaper to buy from, and you sell wherever you are more competitive in selling to, right? So it's obvious that there are certain comparative advantages that countries are able to take advantage of, and so therefore the idea is not to simply wishfully assume that somehow the bar chart will always have equal bars as far as exports and imports are concerned. The operative point here is to try and understand whether what China exports to India, does it reflect its core competitive advantage, and whether what China buys from India reflects India's core competitive advantage. If that is the case, then the relationship most likely is moving along quite healthy lines. However, when we look at what China buys from India and what India buys from China, it seems to reveal that somewhere the composition of trade can actually improve in order to correct the huge trade deficit that seems to be coming up in this bilateral relationship quite consistently. So we looked at a data which runs over 10 years, decade and a half, and the fact is that China seems to be consistently exporting more to India, and India only seems to be marginally improving as far as what it's able to sell to China is concerned. And when you look at the breakup of goods, it seems that Indian exports to China comprise primarily ores, slag, ash and other kinds of primary goods. Uh, just to give you a ballpark summary, and if you look at China's exports to India, it reflects precisely the kind of goods that China can be expected to export to any other Western European country or North American capital. So if you look at China's exports, electronic components, telecom instruments, computer hardware, industrial machinery, electronic instruments, electric machinery, etc. And you find that basically what China is able to export reflects its comparative advantages, but it seems to be the case that China's purchases from India do not reflect India's core comparative advantages. So, what would be India's core comparative advantages? They would be in areas like gems and jewelry, of course, petroleum products, because India has tremendous advantage in terms of refining crude oil. So, we would import a lot of crude oil, and we have a lot of refining capability, which allows us to refine it into different products, different petroleum products, ranging from not just petrol, diesel to, but basic products like Vaseline or other kinds of products that can be produced industrially from crude oil, right? So this is what appears to be, and this has been the trend over the last several years. So you look at gems and jewelry, you look at textiles and garments. India does pretty well in that sector. Textiles, particularly like silk, jute, cotton. These would be your ingredients to manufacture apparel. Like the shirt would be the apparel, and the input that goes into the shirt would be either cotton or silk or whatever material that is used. So India is pretty good as far as that category is concerned. Pharmaceuticals, again, pharmaceuticals is an area where India is ranked fourth, as I've mentioned, in terms of some of the vaccination programs of the United Nations. I think India plays a huge role as far as meeting global requirements for vaccination is concerned. A lot of vaccination programs, whether it relates to polio, whether it relates to many other immunization programs, a lot of those are managed quite successfully because of the competitive prices at which Indian pharma companies are able to supply these drugs. It's not just for vaccination and immunization. You look at even maybe treatment of more serious illnesses like HIV/AIDS, and you might be familiar that it requires regular kind of treatment through ARVs or antiretroviral drugs, and those can be very expensive if you are thinking of maybe some Swiss manufacturer. But when you talk of Indian pharma sector, they are able to provide it at very competitive prices that allows maybe even the global fight against HIV/AIDS to be somewhat successful by virtue of what India is able to provide. So this is just to sort of help you understand that some of the core comparative advantages that India has do not seem to be reflected in our trade with China. So that is the imbalance that one needs to focus on. So that's one side. In terms of um, the composition, I've just given you here on this slide a two-level breakup from the United Nations Comtrade database. I mean, for future purposes, in case you ever work on any papers that require trade data between countries at different levels. So I mean, like if you want a further breakup of mineral fuels, they'll have even more in-depth data on what kind of mineral fuels are being reflected in that category 27, for example. But I just thought just to sort of list out at a basic two-level detail. So you have ores, slag, ash, you have copper, you have mineral fuels, bituminous substances, etc. Bulk of India's exports to China seems to be primary goods. If you look at China's exports to India, electrical machinery, nuclear reactors, machinery, boilers, iron and steel, interestingly. So if you just look at one category, say for example ores, and compare it to iron and steel, it's very evident that primary goods by exporting primary goods, you have very less scope of value addition. It's not that primary goods cannot be the major export for countries. That's not the point we are trying to make. But the point here is that primary goods leave very little scope for value addition. So compared to, say, mining of ores, which might be capital intensive, if instead I was exporting iron and steel based on what I can manufacture from the ore, I could have created that much more employment, and so many more backward forward linkages could have emerged, as opposed to simply exporting ores. But the point is that it's not that export of primary goods necessarily is a drawback. You look at the entire Middle East, and their core export might just be a primary good. You look at Ghanaian cocoa, that might be an agricultural product that is considered at a premium in international markets, because Ghanaian cocoa might be of superior quality, right? You look at dairy products that are exported from many European capitals, or chocolates, and there might be primary goods that particularly milk and other dairy products. um, so it's not the case that you cannot export primary goods. The fact is that export of primary goods in the form of ores or slag, etc., it gives you fewer opportunities to add value compared to, say, export of final products like iron and steel, etc. So in terms of the bilateral relationship, if somebody were to point out what is the drawback, of course the obvious drawback is the large trade deficit. How do you address it? The idea is try and sort of allow a reorganization of your export basket, import basket, that reflects better the comparative advantages that each country has. So that's some level of decision that can sort of redress the bilateral trade deficit. Of course, like I mentioned, it's very difficult to find dyadic data which reflects export equal to imports, but at least to some extent you can redress that. The other point that I drew your attention to was the comparative advantage that India has in some of the sectors which are not reflected here in India's top exports. So maybe that could be an area of focus for policymakers in the future, so that they can redress some of the growing trade deficit. In terms of opportunities that both countries have, and here my mind goes back to two examples that I have mentioned previously in terms of India and China coming together. So of course, there are these case studies that were highlighted by the Harvard Business School. One talking of this joint venture between Mahindra and Mahindra and Changling Motors. It was a very interesting case study when they were trying to look at this whole idea of Chindian companies, China, India, coming together and forming this entity which was called as Mahindra Changlin, from what I recollect. And that entity was able to sort of push out another major tractor manufacturer from the Chinese market, the company called John Deere, right? You must have seen tractors which are green in color and have a stag, yellow colored stag as its emblem. So the John Deere tractors, I mean, the fact that India and China could come together and have a product that is able to be very competitive is evinced in that example. And there's also another example of a car that was jointly designed by the Indian wing of General Motors, and I think it was the SAIC in Shanghai, the Shanghai Automotive company there, which had a joint venture design, which sort of, jointly designed, not joint venture, but jointly designed a car that was sold in India a couple of years ago, marketed as the Sail, Chevrolet Sail sedan, right? So it was not a hatchback, it was a mini sedan, which was quite successful in the Indian markets for the time that you saw the Chevrolet around here. So in terms of India, China coming together, it's not just a hypothetical case. There are actual case studies that have successfully looked at Indian companies and Chinese companies coming together, but it's not been easy. Those of you who are familiar with the bilateral political relations can always relate to the problem that I'm trying to highlight. And the problem is that oftentimes you look at the economic ties, um, following a certain pattern that again depends on whether the political relations are at a state of normalcy or the political relationship has broken down. So if you look at the last couple of years, particularly following the breakdown in relations since 2020 and the Galwan incident in the Ladakh region, after that, again, the first casualty, as it were, in terms of other aspects of the relation was a series of measures that were introduced in order to sort of ban Chinese apps. And overall there was a low point as far as the bilateral relationship was concerned. However, one notices that over the years the economic relationship has been very resilient. So if you actually look at the data, bilateral economic data doesn't reveal a sudden dip as far as bilateral ties are concerned. Although the problem still remains that there is a trade deficit, that trade deficit is pretty large. So you're looking at a trade deficit around the 75 to 85 billion dollar mark, right? So you're looking at that kind of a range. I'm telling you a range because it reflects data over several years, but that's been the range of the bilateral trade deficit. And although the political relationship has oftentimes securitized the economic relationship, the fact that somehow there is this debate whenever we talk of Chinese companies in India. There's a security angle which is introduced that seems to be somewhat of a challenge from allowing the bilateral relations to maybe expand fully. If that is the case, as far as say Chinese companies in India is concerned, the other dimension of a challenge for Indian companies in China relates to the use of non-tariff barriers. So a sector that I mentioned, pharmaceuticals, for example, one of the major challenges for Indian companies to expand in China is the fact that there seems to be a lot of paperwork, a lot of requirements for Indian pharma companies to conduct clinical trials, especially for drugs which have already undergone clinical trials here. We have an excellent track record as far as having the most number of US FDA or the United States Food and Drug Administration approved plants outside of the US. Despite that, if Indian companies in the pharma sector, I'm just giving you an example there, are subject to requirements like conducting clinical trials, etc. All of this just means that your gestation period is very long. So companies normally would want to invest in a country, start seeing results, start seeing profits on their investments. But if simply clearance would take time and increase the gestation period, it doesn't really motivate companies to expand or allow them the opportunity to expand. Not that China doesn't allow foreign drug manufacturers to sell there. I've given the example of a Danish company which manufactures, I think it's the #1 manufacturer for the insulin and the treatment of diabetes, Novo Nordisk, right? And they are pretty successful in the Chinese market. But compared to that, if you look at the kind of advantage Indian companies have in the pharma sector, we haven't seen that play out. So two dimensions of challenges in the economic relationship that I have highlighted in this discussion. One is securitization of the relationship, which hinders Chinese companies having greater access to the Indian market. And anytime the relationship breaks down politically, you find that it's manifest directly in the economic aspect of the relationship. And the other aspect is the use of non-tariff barriers uh, by China in terms of the kind of requirements that they put, goes against the expansion that Indian pharma companies could successfully have anticipated in the Chinese markets. But we are yet to see that kind of a presence or that kind of a performance as far as Chinese markets are concerned. If you look at the other aspect of bilateral trade, trade that happens through ports like Mumbai, Calcutta, etc., Chennai, etc., besides these ports, historically, trade primarily used to happen through border trading passes, and here it's interesting that we have three border trading passes that are reflected on your slide. So you can look at uh, the Lipu Lake Pass, the Shipkila Pass, and the Nathula Pass, which are used for trade. Historically, there were even more passes till the 1960s. Before the 1960s, if you look at um, even pre-independence, you had another three passes that were popularly there. In total, I think more than 7 passes were used for trade. But over the years, particularly in recent years, one sees that the amount of trade that happens through border passes has drastically declined. What do they trade at these border passes? This is the list of permissible items. I'm not sure how much this has changed in recent times, but border trade is regulated in terms of what is allowed to be bought and sold. It's not that anything can be bought and sold. The reason being that um, border trade, as you can imagine, if there is a border pass, so for example, if Indian traders in Nathula in Sikkim would want to buy things from the Chinese side, the arrangement is that there would be a designated market on the Chinese side which Indian traders would be allowed to go. So there would be a designated market like Renqingkang, which is on the Chinese side. Indian traders would have special permissions, passes. They don't issue a visa because it's not, because that is local trade. These are traders that historically have been going back and forth, and they are issued special permissions or passes that allow them a few kilometers of entry into the Chinese side, into the Tibetan side. They would go to the mart, they are able to pick up things, and of course the same arrangement is reciprocal. The other side would also come, cross from the Nathula Pass to the Sikkim side. If you look at the kind of goods that are sold, um, agricultural implements, clothes, tea, not surprising, vegetable oils, uh, and of course other items of consumption, cooking, whether it is misri, whether it is spices. You have rice, utensils, local herbs, and if you look at the products which are bought or allowed to be imported, you have again traditional items. I mean, bear in mind that this also reflects the kind of traditional trade that was happening, right, over land. So when you talk of wool or goat skin or yak tail, don't be surprised, because yak tail might have been an important ingredient in traditional medicine, and that is what allowed this trade to flourish for a pretty long time. Um, and so on and so forth. Yak hair, sheepskin, etc. So over the years, if one were to say how could border trade improve, one, again, border trade is, again, it takes the direct impact of any breakdown in bilateral ties. So anything that happens politically, I think doesn't give much encouragement to border traders on both sides. Over the years, I think in terms of trade, it's been just a few million US dollars, right? So the value fluctuates. Again, the nature of commodities, they haven't expanded really over the years. It still remains a very conservative list. I mean, in that list, if I were to go back to that list, um, it essentially remains very primary and consumer oriented requirements, local requirements, nothing to do with the kind of comparative advantage that both economies can have, I mean, if I were to compare this to the US Mexico border and the kind of trade that would be happening across the border, the kind of goods that would be moving back and forth, I think the contrast would hit you, right? So if you're looking at this kind of trade happening at the border, it just reflects that, somewhere maybe in terms of infrastructure, somewhere maybe in terms of mobility, somewhere maybe in terms of trust, somewhere maybe in terms of even, the actual facilities that are available for traders, there is a lot that can be done by both sides in order to improve the lives of people on either side, right? So over the years, you're looking at just a few million US dollars. When I say a few million US dollars, I can realistically say that maybe some of the firms that you find in Mount Road in Chennai, which happens to be a very commercial area, maybe some of the firms that have offices in Mount Road, maybe they have a turnover which is more than a few million dollars, right, compared to the overall trade that we are looking at between two countries. So that is how maybe in terms of border trade, I just wanted you to understand the contrast, and that's why I was giving you an example of the US-Mexico border, just to, and whether you look at, the trade that happens maybe between other countries, maybe border trade has a tremendous scope for being improved, and, it represents roughly less than 1% of the total overall trade that happens between India and China. What are the drawbacks in this? One, as I mentioned, there are very limited items of trade. Maybe that has been the pattern of trade over the years, and it requires some amount of imagination, some amount of political will on both sides to increase the number of items that are traded, and some of the items might actually um, be outdated, and maybe the entire list needs to be revised. So in order to sum up our discussion, and I think the India-China economic relationship, as I underlined at the beginning, it is a very important dimension of their bilateral relations. We are both important economic actors on the global stage, but our bilateral relationship seems to underperform, given the fact that there are so many advantages in terms of the resilience our economies have shown, especially when the financial crisis uh, hit the West, delivering maybe 0%, 1%, 2%, 3% rates of growth in Europe and other parts of the world, and while we were sort of growing at healthy rates of 5 to 7%, and while China might have been growing between 7 and 9%, I mean, ballpark averages, given the fact that we've shown this kind of resilience, bilateral trade underperforms, right? While resource-based exports are a structural cause of worry, the fact that we are still exporting ores, slag, ash, etc., um, the problem with that is that primary goods, primary exports have limited options for value addition, and to that extent, generation of jobs remains limited in comparison with exports of, say, flourishing manufacturing. And that is an imbalance that needs to be redressed. So that is something that in the coming years needs to be redressed. The key problem areas for India and China, as far as expanding the sphere of economic interaction is concerned, is that there seems to be some kind of limited market access for India in China, right? So the example that I built upon when I said that, why is it that Chinese, Indian pharma companies are not able to have the kind of presence that even maybe a Danish drug manufacturer has in China? It basically reflects the kind of market access barriers that Indian companies face, and that's a reality that the Chinese side has to address. Um, that's not to say that Chinese companies don't have restrictions here. There are barriers to investment in India, particularly when one comes across news reports relating to Chinese companies wanting to expand in India, particularly in the area of telecom, for example. There are regularly security concerns that are raised. The other set of allegations is relating to dumping, right? So dumping of goods, basically the fact that maybe the goods that are being provided here, they don't meet the quality requirements, etc. I mean, those are the two sets of allegations that are raised, and these are areas which again require some attention by the political leadership on both sides. The fact that I mentioned that there is limited market access for Indian companies, the fact that there is a perception that there are barriers to investment in India, there has to be ways that have to be worked out in order to address these concerns. So if both countries are able to do it, I think one can foresee maybe some redressal of that growing trade deficit that I mentioned, right? So the point here is not to wishfully assume that, you know, in the bar chart both bars would be equal. That's not likely to happen. But the point here is that at least the comparative advantage that India has, that should be reflected in our exports to China, and likewise, right? So in terms of future opportunities, I think the example that I just cited, those of you who are familiar with the US Canada border trade or the US Mexico border trade would be able to immediately relate to the underperformance along the India China border trade, right? So I think that contrast helps you better understand the first point, that, you know, we need to create a more spatial agglomeration of economic activity. What do you mean by spatial agglomeration? Basically, it refers to, again, an economic theory which goes by the name of the gravity model. Basically, what that suggests is that, you know, a lot of economic growth tends to cluster, tends to sort of generate economic growth based on the proximity of actors. That is where we don't seem to have taken full advantage of the proximity that we have, right? So there in future, the point that we are trying to suggest is that there could be more spatial agglomeration of economic activity. If you look at the northeast of India, and if you compare it to areas which are proximate to China, say for example Yunnan province, or if you further go up, Sichuan, these are areas, places like Chengdu, places like Chongqing, which are very vibrant industrial centers. And if you just look at geographic proximity, one seems to have completely missed out that particular opportunity of creating some kind of growth based on such geographic proximity. So one hopes that there would be dedicated institution building that can harness border trade and that can eventually lead to better mutual understanding and trust. Of course, it's a chicken and egg problem, right? Do you create growth, and does that allow trust to form, or do you first trust? Can that be possible, and only then move forward on economic goals? It's a chicken and egg problem, but a lot of times you find that, you know, once you create a lot of economic activity, it automatically has other dynamic effects in terms of improving the overall growth possibilities, and that could then be a basis for creating iterated behavior in that area, can then create some kind of trust. Once you generate these possibilities, once you sort of look at more growth that is possible, whether it's Uttarakhand, whether it's Himachal, whether it's Sikkim, hopefully other parts, over time, once you are able to reduce transaction costs, right? Right now, there is a huge political question surrounding the disputed boundaries, there are issues of trust, etc. But hopefully once a lot of these topics are broached, I mean, if you ask me examples of what can really flourish, I mean, the first example that comes to mind is, if you look at the Northeast, maybe 90% of India's hydrological power generation capability resides in the Northeast, right? How much of that potential has been actually used? Well, give or take maybe a few points, but roughly 2 to 3% of that has only been used till now. And why I give you the example of power as a sector is that, you know, given the fact that 90% of our hydropower potential is in that area, and the fact that there is a persistent demand for power on the other side. And when you look at power lines, they don't necessarily have to sort of power lines carrying electricity can still be a possibility, even though there might be differences in terms of where the patrolling is happening, or what sort of differences you have. But this is just one example to suggest that there are growth possibilities, there is demand, but somehow there doesn't seem to be that kind of investment that seems to be coming in to generate these kind of opportunities, right? So one hopes that if you have these possibilities built in, so say for example, some of our big pharma centers also happen to be in places like Himachal Pradesh, Sikkim, etc. Can we imagine the possibility that the kind of advantage that we have in the pharma sector, and the fact that China also happens to be an important source for APIs, active pharma ingredients. Can we think of supply lines in this area? Can we think of co-branding? And I've given you examples which are not hypothetical. Pharma sector is a real example. Hydropower capability is a real example. And like this, of course, there might be other experts who can sort of identify what might be the possibilities. But if those possibilities could be realized, you might be looking at reduced transaction costs over the years. You might be looking at the possibility to have better infrastructure in those areas. You might be looking at the possibility that at least with that performance, you can think of lower trade barriers. You might be looking at better communication of ideas, goods and services. You might be actually looking at better capital flows. And of course, as a result of all of these practices being put in place, there might actually be better border management that can evolve, right, in terms of control of trade, um, control of informal trade, basically smuggling or other activities that can be checked, better management of the border as far as movement of persons, etc. is concerned. So these are all the list of possibilities. I mean, the idea is not just to tell you what the problems are, but also to tell you, is there a scope for redressing this. And the sectors that we identified, the points that we raised, of course, it would require some amount of political will in order to make sure that you look at borders not just as sites for contestation, but you look at borders also as sites that allow for co-growth, growing together, right, for many of these areas. As countries with large rural populations, common development challenges, mind you, I mean, even when you look at China, and there is the discussion of China being the second largest economy, at the end of the day, it's still a developing country. The challenges that any developing country would be facing would be similar. So there are tremendous opportunities for both countries. Both countries have large rural populations. Both of them have to deal with neglected social sectors. Both of them have to deal with inequalities. And so, as a researcher, one hopes that policymakers on both sides would now focus on the other non-zero sum avenues that are there to cooperate and to create mutually beneficial opportunities. So, I think on that note, we've identified what is the nature of structural imbalance in the bilateral relationship. We've highlighted what have been the trends in the bilateral trade. We've highlighted what have been the challenges on the Indian side vis-a-vis Chinese investment, what have been the challenges for Indian companies vis-a-vis the Chinese ecosystem, and we've looked at possibilities that are there to improve the overall bilateral economic relationship, including border trade. And I think with that, we've had a fairly holistic discussion on bilateral economic relations, right? With that, I would bring this segment to a close, and more when we meet in our discussion of the next segment, right?